Instead of an extensive deep dive into one specific stock, we will today do an overview of 6 different home builder stocks, briefly giving a profile on each of them and then compare and rank them in what I feel are some of their important qualities. Those stocks will be DR Horton, Lennar, MI Homes, Meritage, NVR, and Pulte. By the end, you'll know a brief profile on each and how they approach the industry and which ones might be better investments depending on what qualities are most important to you specifically in a home builder stock. We'll also do very quick example valuations on each. This video assumes that you've already watched my extensive explanation of the home builder industry in whole, and I'll reference many concepts that I explained there, so make sure you go and check it out first if you haven't done so already. I provided a PDF link in the description of this video to all the images that I created for today. And if you want to use any of my info for your own research notes, feel free to download that or just use it as something to look at as I go along. First up is DR Horton, ticker symbol DHI. This could be thought of as the value home builder. Their home quality isn't spectacular and customer reviews are mediocre, but the home buyer gets a lot of house for the cost. Their average home price is well below the average for the industry. They've been in business since 1978 and they've now become the biggest home builder on a revenue basis. In this industry, like most, size is a big advantage. Bigger home builders can get deeper volume discounts with their suppliers and contractors, and they can get more preferable debt avenues. They can afford the option to buy out the small home builders as a way to enter certain markets more efficiently. So this industry is dominated by the big home builders. In 2019, in fact, the top 5 home builders accounted for 23% of all homes sold. Because DR Horton is the market leader, a lot of people look to their earnings calls for like a current snapshot of the home builder industry. One key advantage that DR Horton has over competitors is that their 64% ownership in Forestar, which is a publicly listed land developer, gets them a steady supply of land lots at attractive prices. And Forestar, in turn, essentially gets a guaranteed buyer for all their lots. So this discount and ease of lot acquisition gives DHI better operational and capital efficiency because they have better control over the size and location of the land plots. Imagine the advantage that an already good NBA team would get if it also got a top 3 lottery pick every round of every draft. And on top of that, DHI does a fair amount of land options. So between having like grade A choice on the land that they do acquire straight out, and then the mix of using a lot of land options, they're very well set up. And you can see how that leads to high profitability and flexibility if you've watched my other video. So the main takeaway on DHI is I want you to think of them as a value priced builder. They're the biggest in the country, and they're a balance of profitability, growth, and cycle resiliency, which are the 3 factors we're going to look at later in the video. On the opposite side, as far as like the size spectrum goes, MI Homes, ticker symbol MHO, is only somewhere around the 15th biggest home builder by revenue, roughly. Their average home price is usually right around the industry average. They are mostly located in the northern Midwest and southern US. Of the 6 stocks that we're discussing today, they're probably the fastest growing as of late, and we'll look at all of the exact numbers on all these stocks later. They're using 55 to 60% land options, and they focus on increasing that each year. They focus on quality of homes, sporting one of the lowest warranty claim rates in the industry, and on quality of the land that they purchase and control. And that would help in an eventual downturn to some extent to limit how much they'd have to write down assets. They keep their land inventory owned under 3 years at all times, even right now while times are great for the industry. They also focus on keeping low debt relative to their peers that are their size, and as you can see here, they are the best positioned in that category, even more so than many of the giant players in the industry. So the main takeaways on MI Homes is quality over quantity, wise resiliency choices for a small home builder, and even with those choices, they're still growing fairly quickly. The second biggest builder in the US is Lennar, ticker symbol LEN. Surprisingly, they are also currently the fastest recent grower of these 6 stocks. A lot of that, however, is due to their 2018 acquisition of Cal Atlantic. So I guess you would say we just talked about MHO. They're the faster organic grower, and Lennar is a mix of organic and acquisition. Like DHI, Lennar's massive size gives them many advantages that MI Homes and other smaller fish don't currently enjoy. Lennar is one of the more diverse home builders, both in location of operations and in the pies that they have their fingers in. They're expanding their small build to rent programs for both multi and single family homes, and those would improve resiliency to cycles as they provide like a steady inflow of rent payments. They also have around $324 million invested in real estate based tech companies like Hippo Analytics, States Title, Notarize, and the recently successful IPO OpenDoor. They're currently considering spinning off the techs, those rental properties, or possibly both from the main LEN entity. So that'll be something to keep an eye on if you do decide to dive further into Lennar. The big takeaways on them is their size advantages and diversity of both market locations and revenue avenues. But most importantly, when my investing partner shown here and I were perusing a DR Horton neighborhood and a Lennar neighborhood, she was much more impressed with the quality of the Lennar houses. The youngest of these six stocks, Meritage Homes, is the seventh biggest builder in the United States, but their revenues are more evenly balanced across the country than most of the biggest builders. Their source of revenues, however, are the least diverse, with 99.6% of them coming from building and only 0.4% from financial services. Their average home price sold is a 402 grand, which is the second lowest of these stocks behind DHI. So of the six stocks, I feel that Meritage would at the moment be the most bullish way to play the home building industry. And I say that because they are priming everything up right now for aggressive growth. They're going spec home heavy for the next few quarters to try and meet demand that we're seeing nationwide. Spec homes are something that I didn't really touch on last month. So, just real quick, essentially, instead of building a home custom to order for a specific buyer's desire, they are built as like a generic blueprint model and they're mass produced. So, the pros for the home builder on spec homes is that they can produce them quickly and cheaply since they already know what supplies are needed for them and how to make them. And that's actually especially appealing right now for builders because they're all dealing with these supply chain issues. So if there's a spec model that they have that they know they should be able to get all the supplies for without issue, then maybe it's a good idea right now to produce those spec homes in this current environment. But the cons for the builder are that they don't have a buyer already on hand when they do the build. So if the market has a huge downturn in demand in the meantime, they'll be stuck with these spec homes sitting, waiting to be sold. But Meritage is seeing right now as a prime time to go spec heavy, increasing their sensitivity to cycle risk, but also increasing the possibility of great profits and gain in market share, so long as that demand stays as high as it currently is. They plan to do $2 billion in land acquisition and development over the next 3 quarters and increase their number of communities from 236 to 300. And they're currently very low priced by most common metrics. But they do have the lowest land option usage of these six at only 36%. So again, if you're a super bull on the industry, I think Meritage may be the best way to play it right now. Contrastingly, NVR takes a very specific and focused approach to home building, one that's been so successful that it's caused this stock to become one of the best turnaround stories in recent history in the entire stock market, and their approach is now increasingly copied by most home builders. NVR stock has increased 52,000% from its filing for bankruptcy in 1992 to its now fourth largest position in the home building industry. And they've managed to do that by starting and mastering the trend of doing land options, of which 98% of their land is now acquired, and by purchasing almost exclusively finished land, meaning that the land they buy does not need developing, it's already prepared for building. They wait, pay someone else a little bit more to do that work for them, and then they pick it up. With this approach, plus their habit of keeping huge cash reserves, they maintain to be the only builder that seems largely insensitive to the housing market cycle risks. They sacrifice growth for resiliency, They also have been a stalwart of stock buybacks, maintaining around a 4 to 5% average CAGR on buybacks. If you want a best-in-class long-term exposure to a home builder, then NVR is likely your best bet. Lastly, we have Pulte Homes, ticker PHM, the third biggest builder in the United States. Their homes are priced the highest of these stocks at 474,000, but that's still just a hair above the industry average. They're geo-diversified across the country, and in my opinion, they're the most well-rounded of these six builders in terms of growth, profitability, and resiliency. They're also very heavy into buybacks lately, with a 10-year CAGR of around a 3.5 to 4% share decrease. They still have $740 million worth of buybacks approved as of my recording this video, which is around 6% of their market cap. And they constantly maintain a small 1 to 2-ish% dividend, which, by the way, DHI and Lennar do as well. I've prepared several comparisons to eval these six builders, and just for fun as we go along, I'll rank them and give each one scores in three different categories. Number one, growth. Number two, profitability. And number three, we will label as stability. But more specifically in this case, we're looking at how sensitive are they to the risks of the housing cycles. Before we get to those rank comparisons, though, let's flip through a few that may interest you, but I didn't necessarily felt needed to be scored. Keep in mind that these and all the numbers that I'm using today are sourced from each stock's most recent earnings reports, so they're going to be subject to change between now and when you watch this video for yourself. By market cap, you can appreciate just how much bigger DHI and Lennar are than the next closest sized builders. And you can see that even though Pulte has more revenues, NVR has the higher market cap, which tells us that NVR trades at a premium or PHM at a discount, or in my opinion, both. I decided it wasn't quite a strong enough indicator to use for rankings, since all six of our stocks today build at or below the industry average pretty much, but in case you're interested, here are the average home price of each of them. Only Pulte, Lennar, and DR Horton pay dividends, all pretty close to the same amount, but Lennar and DHI have been growing them the fastest. Revenue sources are important to homebuilder resiliency, but I felt that none of these six stocks, or for that matter, any homebuilder, are really that diverse as far as their revenue sources. And we already have a lot of things to rank them for in the stability category, so I'm just going to keep this off the rankings. But you can see DHI and Lennar do have slightly more sources of revenues other than home building relative to these other stocks, but not by a whole lot. And MTH is basically purely making revenues from the home building industry with very little at all from financial services. So they would be the least resilient of these six if we were to grade them. Our first official ranking for stability will be how often do they use land options, which greatly improve your downside risk if the market has a huge downturn. This is best found in an earnings report, and as previously mentioned, NVR set the industry trend for land option usage, and many are and should be following NVR's example. So when we're ranking these, what I'm going to do is I'm going to give NVR 1 point for being the best, all the way down to MTH getting 6 points for being the worst. So at the end of all this, the lowest score is actually going to be the winner in each category. Before we move on, I want to point out that pretty much all home builders across the industry use land options far more than they did a decade or two ago. I tried to find the oldest annual reports I could that mention land options, and I saw that DR Horton, for example, only used 21% back in 2008, but this past quarter they used 76%. Having a footprint in a wide number of states across the country gives you stronger stability against cyclicality of the smaller local housing markets, and DR Horton crushes it here. Days cash on hand is vital for cyclical businesses. It shows you how many days the business could continue its operating expenses, burning purely through cash reserves with no revenue coming in. So search the financial statements and plug these values into the equation to calculate it for your stock. NVR takes stability very seriously, keeping a huge stash of cash, and it shows here as they have double everyone else, Also note that when two of these stocks have the exact same number for a ranking, or if they're extremely close, like within a tenth of a percent, I'm just going to score them equally as a tie. So here I'll give LEN and MHO both a 5 score. You want your builder turning over home inventory quickly so that if a cycle downturns, they will get caught with less supply to write down or discount. And this can be found for free by using a free Morningstar account. Go into operating performance. Unsurprisingly, NVR crushes the competition here too, almost down to a third of the next closest stock. Credit ratings give us two answers really. How cheaply could the builder acquire new debt if they needed to during a downturn? And how good are their overall current debt ratios at this moment to even get the credit rating they got in the first place? You can create a free account at moodys.com and type your ticker in the search, go to ratings and assessments, and view by class. While I usually prefer to use EBIT instead of EBITDA in most of my stock metrics in general, I am a big fan of net debt to EBITDA as a way of measuring the company's current leverage. Using net debt instead of just debt also gives credit to the companies who keep some cash. So NVR is actually negative, and in this case, that's a good thing for this metric, meaning they have more cash than they do debt. None of the builders are too offensively levered, a great sign for the industry as a whole compared to their behavior in the early 2000s. Scoring them 1 through 6 in each of those 6 metrics gives us the best case score of 6 if somebody were to score number 1 in each of the 6 categories, and a worst case score of 36 if they got last place in every category. And NVR just destroys the rest, showing us they have minimal risk to housing cycles. It's only in their smaller geo footprint that they lagged anybody else. Lennar, MHO, and MTH are lacking, and if a massive downturn occurs, they would be much more vulnerable than the others. For profitability, we're going to first score the builders on their trailing 12 months ROIC and then its 5-year average, where NVR has a strong lead in both metrics. Doing the same thing for net profit margins, however, we see that the 3 biggest builders have the advantage over the trailing 12 months, but NVR is still the 5-year leader. For gross margins, Pulte and surprisingly Meritage are the current leaders. But over the last 5-year average, we see that Meritage is actually the bottom score. And really, this shows you exactly why you should always look at 5-year averages as well instead of just the current snapshot landscape. And notice that Pulte is the leader in both columns, actually. Scoring the trailing 12 months and 5 years for each metric in ROIC, net margins, and gross margin, we have Pulte with a very narrow victory over DR Horton in overall profitability. Notice that the smallest builder, MHO, is a very distant last place. And that is again because of the size advantages that these bigger builders have over them, which we discussed in last month's video. If MI Homes grows market share, then they have plenty of runway to grow this profitability. For the growth category, we will look only at 5-year CAGRs because single year, year-over-year growth can be often very misleading, especially coming off of this COVID year. Lennar leads revenue growth, followed by MI Homes, and those two also lead in operating income growth. While I think it's worthwhile to note again that MHO's growth is more quote unquote organic growth within normal build-outs of communities. A big chunk of Lennar's came from that 2018 acquisition of Cal Atlantic, because from 2018 to now, those increases in revenues and incomes have bolstered their growth rates. When it comes to earnings per share growth, MHO is dominating with that organic growth plus all their buybacks. Lennar falls way down to 5th place. Now, ask yourself, just if you're a newer investor, why would Lennar lead in operating income growth, but then perform so poorly in earnings per share growth? Well, that's because one half of the equation in earnings per share is the shares trend. Lennar sold shares as part of funding that large acquisition that we just talked about. So while the growth looks good on paper, as a shareholder, you didn't get to enjoy as much of that because you got diluted along with it. So I didn't score on this, but just to show you, Lennar had a 6% shares CAGR over the past 5 years, while all the other builders bought back more shares than they sold. Scoring each builder on 5-year growth CAGRs in revenue, operating income, and earnings per share, we see that MI Homes and Lennar top the charts. And while NVR dominated stability, They achieve that by making sacrifices in the growth areas, hence their bottom score in all three. So to recap, here were our leaders in each area. Notice that 3 names show up in multiple categories: Pulte, DR Horton, and NVR. If we wanted to get an overall leader, I'll need to double those scores on growth since we only use 3 metrics, and that will let us make all 3 of those balance when we do a total score. Doing that, we get these overall rankings, and we see that the largest U.S. builder, DR Horton, has a sizable lead above its peers. And Pulte scores impressively as well, with a balance across all areas, and by the way, an attractive evaluation at the time of me making this video in November 2021. So that combination of valuation and business acumen might make them your first place to start researching deeper if you're so inclined. Now, here at Teaching Wealth, I take the stance of never telling anyone what to buy, even to my friends and family members. I share these ideas only with you in the spirit of, here's something potentially interesting, here are the numbers, and here are some differing perspectives, and do your own digging, see what you come away with for yourself. So I'll never tell you whether or not to buy a stock. What I will tell you today are my assumptions that I use in these valuation models and why I gave those assumptions, as well as what my fair value ended up being and what margin of safety I would want to personally invest in that company if I decide to do so. Now, we're going to do that through a discount rate today. Since we have to show 6 separate valuations this time, I'm just going to do a more generalized and succinct description of each of them than I normally would, or else this video is going to be like an hour long. But today, since we're evaluating businesses that operate in a cyclical industry, it would be wise to account for true worst case scenarios, which can be more extreme than a lot of other businesses. Doing a 5 years out valuation on these stocks, my assumptions will be based just as much on my personal perception of where I feel like the housing industry will be after that 5-year period, as much as it will be on the individual company itself. But with low vacancy rates, very favorable population trends, and favorable economic and interest rate positions, at least for like the 12 to 24 months coming up, I feel like this worst case scenario is somewhat muted. I feel the market is more likely to go from strong to flat than it is to go from strong to nosediving like it did post Great Financial Crisis. However, with that said, even though revenue decline will be muted, the margins of these builders will in fact still be heavily affected in a downturn. For the 4 builders that I feel are pretty much set up for growth relatively the same, I'm going to use a negative 5% worst case earnings CAGR, and that's if the market as a whole has a sudden sharp decline. I'm going to use a 3% growth for normal case, and then a 9% growth best case scenario. So my 3% growth normal case is my assumption that we're going to see current market demand stay about the same strength over roughly the next 2.5 to 3 years, as it has been the past 2 or 3 years, but then come down quite a bit after that at a slightly negative growth rate. So in aggregate, you're going to get, I think, around a 3% growth normal case for each of these. As I mentioned earlier, Meritage is priming for more aggressive growth than others at this very moment, with their heavy spec home plans and then their big plans on community expansion. And so for that, I give their normal and best case growths a bump. However, in exchange for that method, they're leaving themselves open to more cycle risk than they have historically. And as we showed you with their poor rankings earlier, they weren't really super strong to begin with. So their fall from grace would be much more spectacular in a worst case scenario. NVR makes their moves focusing on less growth and more stability, and thus I've given them a much less volatile growth rate across all cases. Now, it's important to note that I'm actually being very conservative with my 5-year growth CAGR assumptions for these cases relative to the growth rates that analysts are projecting. Here are the 3 to 5 year earnings per share growth CAGRs that analysts are projecting for each of the 6 stocks. And you can see all of them are in double digits. And my assumptions account for, again, my personal feeling that the industry is going to grow well for the next 2 to 3 years, but then pull back in year 4 to 5-ish. And that's, you can say that's me being too conservative, but that's just me trying to be a rational investor. And I can't say that these analysts that are coming up with these double digit growth rates have the same opinion as me. I gotta imagine they don't. But I will say that if you at all even somewhat agree with these high analyst projections and you see the low valuations that these builders are currently trading at, then you'd have to be crazy not to buy some shares in a home builder stock right now because these growth rates are just outrageous. To keep it simple, I'm just going to lump three of our builders together into the following case multiples. And I've separated out NVR and I'm using higher multiples for them because they historically trade at a relative premium to the rest of the home building industry. Because they don't perform as cyclically, analysts and investors have been more willing to trade them like a non-cyclical. And being the smaller two builders, Meritage and MHO have historically traded at slightly lower multiples than the bigger players, so I've muted their target multiples a bit. If you're curious, here are the historic 5-year average PEs. And notice the large premium that NVR is traded at. I expect that since these other builders for the most part have been doing more land options, share buybacks, and cash positioning, which again is how NVR grew to get the respective analysts, that the market is eventually going to acknowledge that and that they will trade at a slightly higher average PE over the next decade. I feel especially confident in that thesis in regards to DR Horton. And to keep things simple, I'll use a 10% discounted rate across all 6 stocks. Using the multiples and the growth rates that I've shown you, here are the fair values for each respective case playing out for each of the 6 stocks. I used the most recently reported trailing 12 months earnings per share for each stock in the year 2021, represented by that small date shown next to the stock's name. That tells you which quarter, which earnings report did I get the trailing 12 months earnings per share numbers for. And then if we weight them at 60% base case, 20% worst case, and 20% best case, and we get the following fair values today using these assumptions until 2026. Here's the current price of each of the 6 stocks relative to the fair value obtained in my valuation, and a margin of safety that's showing you which are the current biggest theoretical opportunities. And I remind you, my assumptions are very conservative compared to analyst assumptions. And on top of that, I always use fully diluted earnings per share. In my opinion, NVR is the only builder that's not on sale right now. Meritage and MHO are trading at the biggest discounts. They're basically already priced for worst case scenario. So if you think that the housing market even goes completely flat at 0% growth between now and 2026, and these stocks just literally trade at the same multiples they do today, then you're still going to make market beating returns historically. And this is because they're just currently priced so low relative to their current earnings. So the question is simply how you feel about the housing market. If you aren't the biggest housing bear on the planet, then these stocks are probably going to look cheap to you. As always, I want to reiterate, this is data going off the assumptions that I personally felt were appropriate. You need to do your own evaluation with your own assumptions. I'm just showing you these as a visual example of a valuation process and also to save you some time if you decide you only want to pick a small number of these stocks to start investigating. If you enjoyed this video, then check out the Stock Shock playlist here on my channel. And as always, I wish you good luck in building wealth for yourself and for your family.